Hey everyone, welcome back to Corporate Decoder, the place where we decode corporate filings so you don't have to. Today, we're diving into the Flat Rock Opportunity Fund's latest update. And let me tell you, after reading this, my opportunity fund is going straight into a pizza because that's a safer investment. This update basically tells us about a change in how Flat Rock Opportunity Fund is calculating its fees. They're now figuring it out based on the fund's net assets instead of total assets. We'll break down what that means, how it impacts investors, and what the fund's expenses look like. First, let's set the stage. This isn't just some random memo, this is a supplement, an update if you will, to their existing prospectus and statement of additional information, or SI, both from April of last year. Think of it as an addendum or revision to the original documents. Okay, here's the main event. As of late February, the way the fund figures its base management fee changed. Before, they calculated the fee monthly, and it was 1.375% of the fund's average daily total assets. Now they're calculating that 1.375% based on the fund's average daily net assets. What's the difference between total and net assets? Think of it this way, total assets is everything the fund owns. Net assets is what's left over after you subtract liabilities or what the fund owes. So theoretically, this change could lower the base management fee if the fund has significant liabilities because the calculation is made on a smaller amount. This could be good news for investors. We can't confirm it does without additional data. Why did they make this change? Well, the fund's board had to approve it, and the reasons behind that approval will be discussed in their next report to shareholders, expected around the end of June this year. So we'll have to wait to find out more about their rationale. It's important to point out the board approval to show there's oversight of the process, rather than one person making the decision. Let's talk numbers. The update includes a new breakdown of fees and expenses. It states that these are expenses that an investor in the fund may incur directly or indirectly. It's a way of saying, here's what you might have to pay. First up, shareholder transaction expenses, which is how much it costs you to buy or sell shares in the fund, is currently listed as none. Now for the meat of the matter, the annual expenses. The fund has laid them all out as a percentage of net assets. This is really important because this number directly impacts your returns. Management fees are about 1.38%. This is what they pay the folks managing the money. Then there are incentive fees, which they explain is 15% of investment income, and that comes out to 2.72%. Incentive fees can be a good thing as they are an incentive for the managers to do well, but they can also eat into your returns. These fees only apply if the fund does well. The fund also has interest payments on borrowed funds, coming in at 2.84%. That's from their borrowing and preferred stock. Other expenses, which include accounting, legal, auditing fees, and trustee compensation, amount to 0.91%. These are the costs of doing business, basically. And then you have acquired fund fees and expenses. These are indirect costs of investing in other investment companies, especially those private funds that operate under certain exemptions. Thankfully, they are zero. When you add it all up, the total annual expenses come to 7.85%. That's a pretty significant chunk. This means that for every $1,000 you invest, almost $80 goes to expenses each year. The filing adds a footnote that mentions that the management fees have been restated to reflect calculation based on average daily net assets. The filing also specifies that the incentive fee is calculated and payable quarterly and is based upon something called pre-incentive fee net investment income. In plain speak, it means how much money the fund made before they take their incentive fee. It's also subject to something called a hurdle rate, basically a minimum return the fund has to achieve before they get their cut. In this case, it's an annualized rate of 8%. The fund has different types of debt. They have term loans totaling $49 million and revolving loans, basically lines of credit, totaling just over $6 million. They also have preferred stock outstanding. The filing also clarifies that other expenses include accounting, legal, and auditing fees, reimbursement of the compensation for administrative personnel and fees payable to the fund's independent trustees. Acquired fund fees and expenses are the indirect costs of investing in other investment companies. To make all this easier to understand, they include an example. It shows what expenses would look like on a hypothetical $1,000 investment, assuming a 5% annual return and that expenses stay the same. It is just an example and is not a guarantee of actual returns. After 1 year, you'd pay $79 in expenses. After 3 years, it's $228. After 5, $368. And after 10 years, $680. The longer you're invested, the more those expenses add up. Now, let's step back and look at the big picture. Flat Rock Opportunity Fund is making a change to how it calculates its fees. They are now calculating the fee on a net assets basis, which is potentially better for investors, but we can't confirm that. Expenses are high, around 8% per year. So what's my take? High expenses. Plain and simple. You need to be really confident that the fund's investment strategy can deliver returns that significantly outweigh those costs. Otherwise, you're just running in place. This isn't to say that the fund is bad or that the fund managers are trying to fleece people, but it definitely means you should pay close attention to performance. If the fund consistently outperforms similar investment options, then maybe those expenses are justified. But if it's just delivering average returns, then you're basically paying a premium for an average product. One of the biggest risks that I see is that the fund relies heavily on borrowed money, leverage, as they call it in finance. Borrowing can boost returns when things are going well, but it can also magnify losses when things go south. So if interest rates rise or the fund's investments underperform, those interest payments could become a real drag on returns. Ultimately, whether or not Flat Rock Opportunity Fund is a good investment depends on your individual risk tolerance and investment goals. If you're comfortable with higher risk and believe in the fund's strategy, it might be worth considering. But you absolutely need to understand those expenses and weigh them against the potential rewards. Thanks for watching. If you found this helpful, please subscribe, like, and comment.